Well, good morning. This is Richard Smith. Wanted to take a few minutes to go over what happened in mortgage rates last week. There was such wide volatility in the price movement in the bonds, really based upon low news. In my opinion, very slight positive news caused tremendous movements in the bond prices, which impacted our rates. I thought it would be good to take a look at what happened last week and the volatility there so we could be better prepared going into next week. Remember, the context of our week, our very highly volatile week, is that mortgage bond prices have been increasing for 3 or 4 months pretty steadily. And they continued that way for the most part during the month of August. There was a brief period in the middle here where prices remained flat, but for the most part the trend had been up until the end of this week. So given the general trend, the context that we're in is improving rates, what drove rates to be so volatile this week? We started the week off with monthly income, the report on monthly income. The market expected a 0.2% improvement, which is what we received. With the Case-Shiller index came out on Tuesday, the market expected home prices to have increased for 3%. Now this has been a steady increase in home prices for several months, so this basically continued to trend. It's not shocking news. They did, however, improve higher than expected, but it followed the regular trend and not way out of line with what has been expected. Consumer confidence was expected to come in at 50. It's an index, and 50 is right in the middle of looking good for the economy, or consumers thinking good about the economy and their circumstances. Below 50s, the consumer is thinking the economy is going to be worse for them. It came in better than expected. These two indexes should have been expected to push bond markets lower and to have a slight improvement in the stock market, pushing rates slightly lower. What happened though, the Federal Reserve came out with their negative comments about the economy from their July meeting. That was enough to move rates lower that day in order to improve bond prices, despite the good news here and here. These bits and pieces of good news were not especially shocking, not especially out of the realm of expectations, and certainly were overweighted by the Federal Reserve's comments on Tuesday. So we came out on Monday and Tuesday with this bond price improvement. This is the day on Tuesday when the Federal Reserve released their minutes, which happened in the afternoon around 2 o'clock, and that's when most of this price improvement took place. This day was the lowest I've ever seen interest rates. The bond market moved very strong positively in the late afternoon and closed at, I don't know if it's an all-time high, but the highest I can remember seeing. So we had the Federal Reserve comments and the rates moved lower. The bond prices moved up on Tuesday, and that's how we ended at basically an all-time low for interest rates. Wednesday, the ADP employment figures came out. Market expected 13,000 gain. We got a 10,000 loss. Should have improved bond prices. Should have improved interest rates. Construction spending expected 0.7% drop. We got a 1.0% drop. Again, should have improved bond prices and interest rates. What we got though was a surprise from the manufacturing index that showed we were expected 52% in the index as far as manufacturing strength. What we got was a fairly significant improvement, which shocked a lot of people, much stronger than had been expected, and that caused rates to worsen slightly, to go up slightly, the bond prices to go down. That was a surprise, but it stayed within the range for that day. On Thursday, initial unemployment claims came out better than expected. Good news for the economy. The numbers here, though, are not quite so significant to warrant the change that happened, the movement in the bond prices, the volatility to happen. Continuing claims came out a little worse than expected, which should have balanced with the initial claims. These have been playing back and forth for several weeks. But the shocker came out with pending home sales. The market had expected a 0% change in pending home sales. Pending home sales is a forward-looking index. Homes that should sell over the next month or 2 months down the road, and so it's an indicator of future activity. What we got was a 5.2% increase. That was the bit of news that really impacted the markets, and rates worsened sharply. You'll see the big drop when we pull the chart back up. So here we are on Wednesday with the manufacturing index coming out, and if you'll see the prices dropped. It opened at 103.44 and dropped to 103.28 at the end. Still within this very, very good range for us, but it was a drop nonetheless. Thursday came out. The unemployment figures did not make this change. What made this change was pending home sales, that forward-looking index. That's a very strong drop for the day, and if you notice, it basically held throughout the day. And here's what happened Friday. This is a unbelievably large drop from the day, and again, it basically stayed. The drop basically held throughout the day. There was a little bit of improvement throughout the day. We are heading into a 3-day weekend, but I actually think this drop here last 2 Fridays ago on no news, it was just a drop that surprised everybody. And these big drops on very slight news, now the drops are understandable, but the size of them is surprising to me. That tells me, confirms for me, that investors are wanting to move out of low yields in bonds and into the stock markets, and they're doing that on any good news whatsoever. Now, to put this in perspective, here is the trend. Here's where we ended up Friday. We are still well above where we have been throughout this whole year, and the trend still is strongly up. But I do think we've established a new range going back to prices that we had at the first part of August. So maybe we're trading in here a little bit. That's actually the question that we've got to answer, that we've got to look for next week, is what is the new trading range. So here's where we ended up Friday with rates worsening on the private payrolls. Rates next week. Bond yields are low. They're still low even after the drop Wednesday through Friday of last week. The home sales, that improvement was big news for everybody. Will they continue? It's certainly good news for the real estate market. Growing number of foreclosures, what's that impact going to have on the housing market, on the overall economy? There's slight improvements in employment of last week. Is that going to continue? That's a big question and an important one for the economy. These are questions that we have to decide. Part of that decision is going to be on how the manufacturing inventories go. Sales were low. Car sales were low last week, which I didn't put in my chart here. And inventories are increasing, which I also didn't put in our chart here. That may depress manufacturing and employment because the inventories are increasing and the consumer demand remains low for many products. New construction is a big question mark. It has been depressed for residential and for commercial. That has to turn, I think, for it to be any significant movement in the economy overall. Next week, we have much less in the economic report world. So hopefully things will be a lot less volatile and we can find some stability in a new trading range so we can kind of predict what the rates are going to do. I'm Richard Smith. Give me a call, please. I hope you've enjoyed this. You can call me at 280-0345 or visit my website at richardsmithhomeloans.com. Thank you very much. Have a great Labor Day weekend.